So now we turn to the highlight of our discussion, which is to talk about the perfect portfolio.
Oh, wow.
Now, we understand that there's maybe no one single definition, but given all the research that you've done, particularly stocks in the long run, I have a feeling that I know what is going to be in that perfect portfolio, but can you tell us a little bit about what our viewers can think about as a perfect
well,
portfolio?
definitely stocks
Sure.
as the benchmark. Half of the world's equity capital is outside the U.S. if you look at market value, and you should not ignore the global picture, particularly today, because we are actually they are cheaper in terms of price earnings ratios than we are. Now there is a little bit of sector adjustment that you do, but basically they're very, in a low interest rate environment, they're very, very reasonable. So don't ignore, I know it's like pulling teeth to get people international, but if you can get there, 50% even is not unreasonable on there. Bonds don't look good to me. People ask me, do you own it? Well, I have cash. Obviously, everyone needs some cash. I said the only bond portfolio I had is back in, I think in 1978, Vanguard came out with its high yield fund. And I bought it and put it on automatic reinvestment of dividends. And so the dividends are so high that, believe it or not, its return is almost stops over the next 30 years.
Wow.
I mean, it's maybe 1 or 2 points below, and I just keep it there. So it's kind of high yield is quasi stock. So I don't own any treasuries. And especially today, with yields being so extremely low, I prefer cash as my cushion rather than longer term bonds. And now that cash returns are actually coming up, it's not unreasonable.
In terms of the equity investments. What's your view in terms of pure index fund versus something that either might have a tilt or sector specific?
I know it's been a rough time for value investors. We definitely know over the last 10 years, 5 years. But I still think for so many reasons, because it's like the growth trap that you mentioned from my book, Future for Investors. People get mesmerized by growth and they overpay. And over time, even if you hold them, whatever dividend reinvestment they do, it's going to be at a smaller amount than if you hold those value stocks, reinvest, or get the buyback return that you're going to get on that. I think that they're going to still perform. So I would definitely tilt towards the value side.
And what do you think about rules of thumb like dollar cost averaging? A number of individual investors seem to like that kind of...
It's funny because, in a way, when my reinvestment of my junk bonds is like dollar cost averaging.
That's right.
It also serves a psychological purpose in the sense that people hate to buy at a point and see it right go down. If you plan your buying, you're going to hit some highs, you're going to hit some lows, but you're going to hit the average. I think it serves a really good psychological purpose for people who are have that regret in their portfolio. Oh my God, I could have waited a week and get cheaper. That's a good idea. So I mean, continuously putting that in, you're going to buy more shares when they're down than when they're up.
What should investors do who are prone to emotions, and how do you set that aside in your portfolio?
That's the hardest. I encourage them to read my book. There's graphs that calm you down when you look. It's funny because when I showed my big 210-year graph, the bear markets, even the 1930s, are little blips. They said, "Oh, come on, was that the Great Depression? Was that?" Yeah. It sort of disappears in insignificance when you look at the upward thrust of the long-run values. So, if you look at that longer run, you're just not so upset by the shorter run. And by the way, I'm not one of these people that like high-cost advisors or something else. But if you need someone to help you stay focused and in equities when times are bad, definitely an advisor can help you an awful lot in terms of doing that. We find that a lot of people who just use the index funds and say, I'm paying 3 basis points, 5 basis points, whatever else, they end up doing worse because they buy too much at the top and sell at the bottom. Even though it's not a stock selection question, it's not a cost selection. It's the emotions that overcome the long run judgment they should have.
What are your views over the next, say, 10 or 20 years for both the market and the aggregate economy?
Well, yeah, no one can predict, but I think there are good things coming. I mean, we see the advances in AI, nanotechnology, in robotics. They're on the horizon. You don't have to be in those companies. There's going to be fierce competition in terms of that. I think everyone is going to benefit. Keep focused on that long run. As I say, despite the political winds that move one way or the other, there's still, look at China has a stock market, Russia has a stock market. The idea is we're going to abolish these markets. No one really has that serious idea anymore. They know markets are really important for allocating capital in the future. So I think you're looking ahead to a situation where, and the emerging market, China, 1/4 per capita income of the United States, 4 times the population. If it gets to 1/2, think the growth is unbelievable. It's another China, it's another U.S. India is even more, with 15 to 20% per capita. If it gets to 1/2, and countries have gone that far. South Korea has gone to 1/2. So there is unbelievable potential in those countries to grow, and they're going to buy our goods as well. You don't have to buy their companies to get their returns, because our companies are going to serve them also.